Red Lobster, the popular seafood chain, has officially filed for Chapter 11 bankruptcy.
I declare bankruptcy!
But how do they get here? And what does Chapter 11 bankruptcy even mean for them? While the endless shrimp promotion has gotten a lot of the blame in the media, trust me when I say it's just one piece of a much larger puzzle. This isn't just a story of corporate decline. Red Lobster has been burdened by decades of scattered strategic decisions, now struggling to even stay afloat. In the business world, survival often depends on your ability to innovate and adapt. So what exactly went wrong here, and will this restaurant chain survive this bankruptcy? Now, what most people think of when they hear bankruptcy is that a company or person has no more money and they're going out of business. And while there are two common kinds of bankruptcy, Red Lobster has filed for Chapter 11, also known as reorganization bankruptcy. This allows a business to continue operating while it develops a plan to repay its debts. The debtor, in this case, which is Red Lobster, must propose a plan that's in the best interest of its creditors within a timely fashion. The plan should keep the business running during and after the bankruptcy and can last from a few quarters to several years. But if the debtor doesn't submit a plan, creditors can propose one. And in other words, Red Lobster is trying to reorganize their company and continue staying in business, at least for now. But Red Lobster wasn't always serving up endless controversy. In their origins, back in 1968, when owner Bill Darden set sail on his dream, opening the very first Red Lobster in Lakeland, Florida, it was a single restaurant with a focus on fresh, affordable seafood. The concept was a hit, and soon Red Lobster was multiplying across the South. But by 1970, Darden and his crew decided to set a new course, selling the now 5-restaurant chain to General Mills. Yeah, the breakfast cereal giant General Mills. General Mills had saw an opportunity to diversify their offering, and under their ownership, Red Lobster became a national name. If we fast forward to the 2000s, the tide shifted again though, and General Mills decided to spin off Red Lobster into a separate company called Darden Restaurants, which also included brands like Olive Garden, Longhorn Steakhouse, and several others. But this is where things start to take a turn for the worse. With Darden Restaurants being a public company, it began to face outward pressure from activist investors. Red Lobster was experiencing a decline in sales in a portfolio of other well-performing restaurants, like Olive Garden. Seafood at the time was experiencing some huge industry changes, and the cost of global seafood began to rise significantly, eating into Red Lobster's profits. But it wasn't just the price of seafood that caused the decline. See, casual dining has been experiencing a decline for the last decade, and Red Lobster did little right when it came to evolving with the times. They were stuck competing with fast casual restaurants like Chipotle and others that had cheaper price points and more convenient offerings. Now, as a result of all of this, it was not getting the necessary attention from Darden. So in 2014, they succumbed to that pressure from investors and sold it to a private equity company called Golden Gate Capital to the tune of $2.1 billion. Now, the reasons for the sale would be foreshadowing for what was to come later. With declining sales and a failure to bring in a new customer base with the younger generation, it wasn't necessarily clear how Golden Gate Capital was going to turn around this business. Now, if you're unfamiliar with how private equity companies typically like to do business, well, a common theme is that they will prioritize short-term gains, often at the expense of any long-term growth or success. And that's exactly what Golden Gate Capital did. In 2014, one of the first things they did was something called a sale leaseback on numerous Red Lobster locations. This is a common strategy for private equity companies to do, where they'll sell an asset in exchange for capital up front. In this case, Red Lobster's real estate. Once sold, Golden Gate would then liquidate the restaurant's biggest assets and then negotiate a lease for that same property on behalf of Red Lobster, keeping the same location, just reworking the financial structure. Why would they do this, you might be wondering? Well, gutting their assets to come up with capital is much more in line with short-term results. They aren't going to care when eventually those leases don't make financial sense for the business, because in theory, they will already be gone. And of course, if they're buying into a failing restaurant chain, they're going to do everything they can to raid that business of any assets worthwhile. Interestingly enough, Red Lobster cited in their bankruptcy filing that in 2023, they spent approximately $190 million in lease obligations, and over $64 million of that related to underperforming stores and said to be priced above market rates. Now, I can't be sure what Golden Gate sold the real estate for to begin with. It's rather telling that in the filing, Red Lobster is acknowledging paying over market rates for these leases, which clearly didn't help their decline in revenue, as sales have been down 30% just since 2019. However, in 2016, Thai Union Group, a seafood conglomerate, bought a 25% stake for $575 million. This would value the company at $2.3 billion. This is only 2 years later from when Golden Gate Capital bought it. Interestingly, Thai Union Group is known for its retail sales of seafood products, such as Chicken of the Sea, a canned tuna business, and Red Lobster was their first notable investment of a restaurant chain. Now let's take a second to go back to 2003 so you can understand the irony of some of these bad decisions that have plagued Red Lobster. Back in 2003, Red Lobster ran an endless crab promotion to get more customers in its stores. This promotion worked in the aspect of getting more customers in the door, but it came with a catch. Red Lobster said to have lost $3.3 million in 7 weeks. A Red Lobster executive claimed that it wasn't the second helping on all you can eat, but the third, causing the loss in revenue. Fast forward to today, and we see a very same issue repeating itself. Despite signs of it clearly not being a financially sound decision, last summer, CEO Paul Kenny decided to turn the $20 endless shrimp deal into a permanent menu item, instead of keeping it for what it was, which was a traditional limited time offering. The deal was once again too popular, and Red Lobster was unprepared, resulting in Thai Union citing $11 million in losses. Following this event, Thai Union CEO stated that we were expecting an increase of 20% in customer traffic, but the actual number was up to 40%. Now, I told you at the beginning that this was just one piece of the puzzle. So what if I was to tell you that cited in the bankruptcy filing, Thai Union Group was the only shrimp vendor for Red Lobster, overcharging them and skipping quality reviews, leaving Thai Union with an exclusive deal that led to higher costs for Red Lobster. It's currently being investigated in the bankruptcy filing how exactly Thai Union Group used Red Lobster and this endless shrimp promotion to exercise their outsized influence on the company's shrimp purchasing. And while I'm sure that investigation won't leave any current employees culpable, it's important to understand that when we hear about the endless shrimp offering for only $20 and that being the sole reason for Red Lobster's demise, we can understand that this narrative doesn't fully encompass the pillaging that's been taking place of the Red Lobster brand. The Thai Union was notoriously known for cutting costs any way they could. One example is them pushing waitstaff to the brink by having them cover 10 tables at a time as opposed to their normal amount of 3 in an attempt to save on labor costs. According to CNN, who spoke to a former Red Lobster executive who had to remain anonymous because of an NDA, they said that the menu decisions were driven by an executive's opinion and not customer preference, and that it was miserable working for them in the last year and a half. Red Lobster has seen a total of 5 CEOs in the last 5 years, including changes to other C-level executives like Chief Marketing Officer, Chief Financial Officer, etc. And this just speaks to the problematic leadership of the company ever since it was purchased. According to former Red Lobster Divisional Vice President Les Foreman, Thai Union didn't have any idea about running a restaurant company in the United States, and as a result, Red Lobster reported losing $76 million in 2023 alone, and Thai Union Group blamed the pandemic as well as sustained industry headwinds, higher interest rates, and rising material and labor costs. As of Wednesday, Red Lobster had closed 99 restaurants across 28 different states, in some cases without informing employees who showed up to work, only to find announcements of its closure, which may be a potential labor law violation. In the bankruptcy filing, it's listed that Red Lobster has liabilities in the $1 to $10 billion range and $30 million in cash. Of course, they still have other assets, but those will continue to be liquidated throughout this process. So while their future remains uncertain, the story should serve as a cautionary tale. After decades under General Mills, Red Lobster found itself acquired by private equity firms focused on short-term profits. This shift absolutely led to a neglect of long-term growth strategies. Further complicating matters, the acquisition by Thai Union has raised questions about potential conflicts of interest. Did Thai Union prioritize selling their own product through Red Lobster at the expense of trying to revitalize the restaurant, knowing the entire time that it would cripple the brand? I mean, the analogy of a lobster being picked clean of its valuable meat only to leave behind an empty shell seems really fitting here. Thai Union said it would divest from Red Lobster in the bankruptcy filing and take a $530 million loss on its investment. So while the brand clearly made several mistakes over the last 20 years, to me, it seems that over the last decade in particular, the different people in charge blatantly set this business up to fail, looking to squeeze whatever profits they could out of it without any consideration for the 36,000 employees at the company. Look, restaurants are a tough business, but in most cases, their purpose is incredibly simple: provide good service and quality food at a price point that resonates with their customer base. Once they moved away from that simple premise and the corporate vultures swooped in, it's not too shocking to see how they wind up in the United States bankruptcy court. Now, if you enjoyed this video, please be sure to subscribe. And if you want to learn about how this one move completely revitalized Domino's Pizza, I covered it in this video here. Be sure to check it out next. Thanks for watching. Peace.